Right. S12BA explained. And from there, we've invited the principal of Gaia and the principal of Jaltech, that's Renier DeWitt and John T. Sachs. We're privileged to have them to join us, and they'll be presenting on their Section 12BA offerings, quite exciting opportunities. And then we have 15 minutes for Q&A. I really encourage you all to put your questions in the box. It's always good and creates engagement at the end. Yeah, and we definitely will answer every question in the 15-minute Q&A. So I just get started because in a webinar we don't want to keep it too long. We try to keep it to time. So on my side, yeah, retirement comfortably is something close to my heart because South Africans, we really have a problem with that. Yeah, so most people are worried about their retirement future, but generally do not spend enough time looking at their wealth on a regular basis. So what happens is that there's a lot of assumptions, and times when you get closer to your retirement, you realize that the actual returns were not close to the actual estimates, or you didn't put enough cash away in time, etc. In terms of the directors, I've been at Innovate now for 7 years now, going to be. And basically, I've got 30 years experience, come from an entrepreneurial background. My dad was in business in distribution in 1954. We're a family of business people. And I think what I love is helping people grow their assets and especially making money for people. That gives me the most joy. Matthew Lee, my partner, is ex-Ernst & Young. I'm ex-KPMG. He's also basically qualified in 2016. We've been going now, it's his 8th year, and we make a very dynamic combination. In the starting, Matt should bring a lot of stuff I should reject, and now we've got a line in the sand as to what opportunities we would consider and what we would reject. And I think on average, we've got a diversified portfolio. We'll share a page later. Yeah, and I think we've done pretty well. DD is the reason why we exist. Pretty strong DD, and we do spend time. Yeah, a lot of times, 9 out of 10 times, we say no to people. Just to make it a bit light, I thought instead of showing people all the bad facts about why you can't retire, I just want to say, hey, do you guys want to live life on your terms, or you want to live where retirement dictates how you live, and thought I'll show some pictures, people enjoying their life and also living times on their terms, at their choice, even financial freedom is an important thing to live where you have a choice of working part-time or whatever you want in life, rather than where the circumstances are conditioning what you have to do. Now, one of my areas that I don't really enjoy in South Africa is 94% of people can't retire. And, the inflation is at 6%, which is higher than most developed countries, over a long time. And the rand depreciates at 5%. And in offshore terms, your rand is halving every 10 years, So if somebody just got caught up in their business and they didn't do offshore and they had a need to do offshore, maybe their children were looking at studying overseas or looking at possibly immigrating, then what's the purpose of actually building assets only in South Africa if they're going to be living in the UK or a country where they'll need foreign currency? The solution from my side is, which I've really shared over 30 years with different people, is save before you spend. I'm going to cover this pretty in detail in the next couple of slides. And from an early age, which is something in South Africa we don't have so much. And second thing is that we found that we work with FSCA brokers and financial planners. And if you do diversification with alternative assets being 20 to 30%, and FSCA being 70%, or you're doing share portfolios and other stuff, it does create a nice mix to earn average over a long term. I'm talking about 20 to 30 years, at least between 8 and 12% over the period. On the FSA side, there's sometimes more volatility at times because the market, it goes up and down, but over time, hopefully you're getting, double-digit returns. So this is an area that I've actually done a lot of reading about, and I wish we could change our culture in an instant, but we can't. So I took this example of sharing what is difference between South African investors and Swiss investors, you know. So in South African investors, I'll go to that pot point, you know, generally they live beyond their means, they consume first and save what is left. And sometimes there's not much to save at the end of that if you have that attitude and that conditioning that, you know, I'll save when I can. A lot of times they get caught up in the debt trap. We've seen people that are earning even 5 million, but they spend more than that, living in big houses that are 10 million plus, you know, starts with big bonds. So I've seen many high net worth clients where their assets outside their house is very little, you know, at 45 or whatever. And the other two are really relevant in our South African society. The difference between that and the Swiss mindset is, you know, the main thing which I love about the Swiss side is top 3 country in the world in terms of GDP per capita, and they learn how to save from a young age. They learn how to budget. Children understand if they don't budget and they spend on unnecessary things, they don't have further money coming, and that's a good thing to have from a young age. It's a stunning culture that they have created, and this is one of the reasons why they're number in the top 3 in the world in terms of, you know, the strength of the economy and the wealth of the people that are there. So their mentality and attitude towards saving is always positive because they understand that savings can create a better life. They're prudent about their money, and the main part of which I wanted to share. And if you take nothing else from this webinar, just hopefully you take this one thing. Some people would be doing it on the webinar. I'm sure there's some, I know quite a few of the clients. And welcome everybody. Hope you'll enjoy it. So 22% they save first, and they live on the remaining 78%. So they actually get a net salary. They save 22% and sometimes even more, and then live on the residue, which is really the way one needs to save. And in other countries like EU, they save 10%, US 12%, and South Africans 0.5%. Yeah, it's really ridiculous. So this is a book I've read again recently. Morgan Housel is the author. This is the second thing I would just say. I know we're going to be doing 12BA. It's called The Psychology of Money. And I just wanted to share, you know, like sometimes we get money easily and sometimes money doesn't come to some people. But there are 3 things that really stuck out in this book. And I read it recently again. It's in top 10 in exclusive books. You can also get it from Amazon. I really would encourage you guys to get your hands on this book. So it talks about respect for your assets. There was an example of an IT entrepreneur that made some good money, you know, in the millions, and then he started getting very loose with his cash, giving $5,000 tips, and you know, very arrogant also. The ego side can lift when you actually make some good money. We all have that challenge when you do well, and I'm sure many of you can identify with that. So the more down to earth you can be while you're building your wealth, the better, you know. That actually chapter broke after that whole experience. So there was another example: prioritize your saving before spending. There was a janitor that actually was a multimillionaire when he was retired, and he invested in shares and stuff for a long time on a consistent basis. And yeah, he was a multimillionaire. And people ask, how would you as a janitor be a multimillionaire? And it actually proved the point. If you save and you try to do a lot of growth assets over time, it does pay. Obviously, selection of assets is another thing. Yeah. And it's not a science, it's a decision. I just want to say to you. So Morgan Housel is the author. Yeah, financial freedom is about having control of your investing wisely and reaping the benefits. Yeah. I thought I'd share a quote because for me, the thing about building wealth, it's quantum, right? This first part, like save before you spend. And I thought this quote was quite appropriate. Is for him who has conquered the mind is the best of friends. But for one who has failed to do so, his very mind will be his greatest enemy. And yeah, we all know the power of the mind. If you have the right end of it, you can do so much. If you start falling towards your senses, you can also go the wrong direction. So I thought I'll share this because sometimes people forget, you know, either they get caught up in their work. And yeah, I've seen so many people. I had a client, a physician that came to me recently, and he had 3 million in assets at the age of 45, you know, outside his home that was 8 or 9 million that was nearly paid off. And I said, like, you know, although the house is a great asset, it doesn't generate income. It's a lifestyle asset. You need to have assets that are going to be there when you retire. And yeah, this thing is about quantum. The return is, if you're earning 4 to 6%, you're only in the 2 to 4 million rand mark. That's right up to 8%. If you start moving towards 12, which I think is a good target for people to have, not to go crazy, and infrastructure assets and certain assets can give you this return over a long period. The return goes to 10 million over 20 years. And yeah, if you do 15, which is quite, amazing, it'll be 16. But at least if you can get to 10 million, for every million you could convert to 10 million in 20 years, you probably won't have a issue when you retire. So yeah, in the FSCA side, we are licensed on the FSCA side, Innovate Alternative Assets, although we focus on alternative assets. Yeah, I think most people are aware of some of the options that are here. And for retirement, you can see, I think a lot of people are aware of those options. On the alternative side, I sort of define that for anybody that hasn't been exposed to us. Firstly, it doesn't fall in the category of stocks, bonds, and cash. Listed stocks, that is. Yeah, so obviously if you do unit trusts, you do endowments, you do retirement annuities, pension funds, the inherent asset is a listed stock, bonds, and cash as a rule. They very rarely invest in unlisted stocks, yeah. And yeah, the pension funds in South Africa only invest 3% in alternative assets, whereas in the world, between 35 and 45% in alternative. This is kind of the talk of the international world. So on the options are private equity, we're normally targeting over 20% IRR after tax. Private debt, which is a really powerful option right now, the second best performing asset in the world. The good thing is that Matt and I have been doing this from 2018. This is with security from either 50% security, 1:1, right up to 5:1. Yeah, and the returns are between, Matt will share that later. Infrastructure assets like fiber, alternative energy, roads, areas we love because it's got long-term contracts and income, power purchase agreements, and fiber assets underground that's generating income. It's just as great. Tax deductible investments. We're gonna cover that now, so I'm not gonna go through that. Impact investment like agri and other areas that have high impact, but also where it's kind of export biased. We do love that. You don't have to invest only in listed stocks with Rand Hedge. You can also do unlisted stocks with Rand Hedge. So we do have a few opportunities in that space. We don't really do venture capital, but it's in alternative assets, property assets, and a few bespoke options. Property is part of this area. So yeah, we have 2 assets overseas with it. And then alternative side, we thought 12BA is a good option to share from a retirement option because it's got a 13 to 20-year play. And you're getting most of your money up front, which is, de-risking by year 1, by year 2, by year 3. And then the rest of it is profit, and then you've got a 13 to 14-year moderate risk play, which is quite nice. You can also do opportunities for growth, which you can liquidate at retirement, opportunities for income that can supplement your annuity income when you retire. The main thing about alternative assets, we have consistency of returns. A lot of times, with the thematics, private equity and alternative, we don't really go into areas where we don't believe that area can generate a return in this economy and for a client. So it's a bit bespoke. It's linked to a particular inherent area, and that's what leads to the consistency. We're not this in a general market which can go up and down. So there's low correlation between the listed. So it's a very good place to have some value or choose alternative assets as an asset class alongside your other assets that you have. And generally, there's less manipulation in an unlisted asset. Sometimes, it is listed, but we raise in an unlisted environment. And we don't have the same effect of shocks in other areas that a listed stock is exposed to. And you must know, in the South Africa alone, over 30% and more now are actually unlisted, have come off the JSE because of some of the negatives about it being listed. I wanted to just share with you, obviously, the returns, in the venture capital space is similar to private equity. This is the area, our sweet spot, the private equity side. It's nearly double of what you can get in the US market, and that's over 14 years. Yeah, we had an example. I had the privilege of presenting to physicians about 3 weeks ago, about 100 physicians. And I took this example, and we could do this for you also. So example of somebody was earning, all those values over the period, 5 years and then 10 years, and in a period of 38 years. We said if you contributed 10%, 20%, or 30%, I thought we'll use 20% since we're talking about the Swiss mindset. So that's in the 45 to 65 years, you're putting 48,000 away a month, or close to 600,000 a year. And then in the 35 to 44, that's 420,000 a year. And just to share with you, like if somebody put 20%, they would have contributed 18% for the 38 years. The value at 6% is 53 million, 8%, 81 million, 202 million at 12%. And that's what the power is. If you can just get closer to 12, you get 2.5 times the value. And yeah, 20% is a good quantum to invest. Hope by the end of this webinar, you're convinced about that. So just to share the nominal value retirement, this is just in a graph, the same numbers I shared, 200 million, 80 million, and 50 million. Also, don't forget, you get nominal value, which is at normal value, and then you get real value, which is net of inflation. We're taking it at 6%. So if you took inflation at 6%, you would have made zero. It's worth 18 million. And if you made 8%, it'll be 2% return net, which gets closer to 25 million, and 54 million. That 200 million is actually 54 million in real terms. We all complain about that, like what a burger cost in 1980, but we forget that going forward also, we may think we got 200 million, but it's not worth 200 million. So my final remarks, and I'm nearly out of time. The first thing is get your finances in order. I always encourage our clients. We have about 70 high net worths now in the 6-7 years that we're operating, and 5 family offices that we work with. Is spend at least 2 hours on your investments once a month. Yeah, it really will be worth your while, and also connect with the right people. Try to build your network and have the right people working as partners alongside you. And the second part, safeguard your retirement with a Swiss mindset. Don't invest less than 20%. I'm sure in this webinar, there's probably a lot of people that invest more than that. They may be thinking like, what are you talking about, Anil? But for the people that are investing 5% and less than that, hopefully this gives you a bit of a wake-up call that we need to start catching up. And then make sure we have vigilance, and people that are working with you allow you to at least earn double-digit returns. I just shared with you what the power of 12% is alone. Yeah, if you'd like to contact us, you've got our details. Thanks, everybody, and enjoy the rest of the presentation. Now I hand over to Matthew for the 12BA.
Thank you, Neil. Thank you so much. Yeah, very interesting and exciting presentation there, Neil. Fortunately, like I said, I always believe I'm probably the youngest in the Zoom thing here, so I've got the best chances of possibly retiring comfortably one day, right? I think the other thing that you mentioned there is at 8%, and just for the room, we did a statistic, and we got some fact sheets from Morningstar, and we did a comparison of what all the funds in South Africa did over the last 10 years. And the average return across all the funds being over 5.7 trillion has been around 7.5% to 8%. So hence the reason why 95% of our population can't retire, right? Because all of them are just beating inflation by 2%. But anyway, let me get into my presentation specifically. I see we have a lot of our clients here. So we obviously made them a lot of money, and they've got a lot of taxes that they need to pay. So you guys are at the right presentation today. We are going to be talking about Section 12B and how Section 12B can effectively assist and help you guys, use your SARS money towards some retirement investments. So I just want to start with what Anil spoke about, alternative assets and our current performance. Jonty also mentioned, I think there's a few guys already in the room, so I thought let me just bring the slide up. As a company, we've been operating for almost 6 years now. These are the areas that we do play in with private debt, property-backed assets, private equity, income-deed partnerships, tax incentive schemes, which investments which we've done previously was 12J and 12B, and offshore opportunities. So these are actual opportunities and returns that we have been achieving for our clients in each of these areas. Obviously, each of them have different collaterally backed assets. Some of them at 4 or 5 to 1, some of them at 40 or 50% to the original investment. So depending on the amount of risk we take, obviously the less the return would be. But on average, when we've done reviews, we've managed to give our clients an overall average return of 15% on the funds that they've invested with us as an entity. So that's just a little bit of history and current performance of Innovate and what we've done for our clients and the current alternative assets we invest in. So what are we talking about today? The excitement today is all about SARS giving us money back. And yes, it's exciting. We don't often get this. And when we do get it, we need to make sure we take full advantage of it, right? So one would ask, what is Section 12BA? Okay, so Section 12BA allows taxpayers to claim a reduction of up to 125% on any assets that generate power. So this could be wind farms, hydro farms, and solar. So any asset that generates power, if you invest in it, you get 125% tax back. That's what the Act says, right? Now, many would possibly ask, why did SARS do this? Why did this come into being? Why would SARS want to give up this income? So SARS obviously introduced this purely to tackle the electricity challenges that South Africa has had in the past few years with load shedding. Okay, and why? So the big question is why? Is because government has lost more than 200 billion, yeah, right, due to load shedding and insufficient logistical issues by Transnet since until November 2023. There's been much more since then. But effectively, any blackouts that last between 6 to 12 hours, cost the economy between 200 and 900 million. So 6 hours of blackouts cost the economy almost 200 million at a time. So the only way for SARS to combat this was to actually get the private sector involved. There was an interesting stat saying that in South Africa, we currently use about 40,000 megawatts of energy, right? And that's the capacity or the usage. SARS was only producing at some point 25,000. Since Section 12BA has been introduced and private sector has taken, and many individuals as well, including yourselves, I'm sure many of you guys have solar on your roofs, we've actually taken up almost 20% of what the grid requires just from private use. So there's already been a massive impact in the economy as a result of the private sector getting involved in ensuring that they provide their own power. So how can I invest the benefit? Right. So obviously, whenever you submit your final returns, whether you be a company, an individual, or a sole proprietor or trust, when you submit your final returns, you would then show that you've invested in a Section 12BA investment and you'll get the reduction. Just a little bit further explained on Section 12B. The guys will give you much more insight to it, but I want to give you the overview as well. There's no limit. So those that are currently investing in RAs, you guys will know you guys have probably a limit, I think, of 350,000 that you can invest in a year. Section 12J, when it was around, had initially no limit, and then they capped it to 5 million. Right now, what's exciting is Section 12BA has no limit. So, I mean, we had some guys last year invest over 10 bars just from their tax savings. So there is no limit, and we could potentially wipe your entire tax bill. It's only available until Feb 25 next year. We're not sure if it will be extended. I highly doubt it. As I mentioned earlier, SARS also doesn't want to, or Eskom doesn't want to lose out all of its potential future income. So they just needed the interim to get the power, or to get power on the grid again. So deductions can range anything from 125% to 250%. And as I mentioned earlier, it's for individuals, companies, and trusts. Okay, so I just want to quickly explain the structure so you guys understand it and how someone would invest. So each investor would be seen as a limited partner to what we call a partnership, all right? Everybody would invest in, depending on the underlying entity, what the minimums are, but anything from 250,000 upwards would invest into a partnership. And this partnership would then have the cash, which it would buy solar assets for, right? Our fund managers, in today's case, Geltec and Gaia, would go and find off-takers or clients to go and buy our electricity from us. So this is where they would approach clients. They obviously do all the credit checks, ensure that the client is a reliable and a good long-lasting client that we can work with. They would negotiate with them a fee for electricity, and to usually be less than what they currently pay in Eskom. So for a client, it makes great sense because they have uninterrupted supply of power, and they're usually going to pay less than what they currently pay in Eskom. So, and they're also not purchasing the assets with their own funds. It's off their balance sheet, so it doesn't affect them in any way. So this is how it would generally work. The returns they can, the electricity that they buy gets sent back to the partnership, and then the partnership pays its investors from there. Okay, I'm gonna do a quick example. I know I'm running out of time here, but I just think this is the important part for you guys to understand. If anything, this is the most important part of this webinar, and you can then decide between the guys that I'm going to be presenting how and which fund you'd like to go with. So effectively, I just want to show if a person earned 3 million rand, right? And this was their taxable income. Assuming they did absolutely nothing, they would pay 1.1 million to Sars, right? That's what the tax would be. And what we're saying is taxpayer B decides, okay, they want to do R1 million investment into Section 12B, right? Can you see they get 125% deduction? So they initially taxable income would have been 3 million. They're getting 125% deduction on their million, which is 1.2 million, which leaves them with a taxable income of 1.7 million. Now, tax on 1.7 million, if you look at the tax tables there, they will end up paying 600,000 rand in tax. Okay, so from here already you can see, as opposed to paying 1.1 million, they're only paying 600,000. So on the million rand, they saved 560,000 rand in tax. So R1 million investment cost them only 440,000 rand because SARS paid the other 560,000 rand. But then we have really intelligent guys and smart guys, and they said, listen, let's use leverage. And both Gaia and Chaltech are using leverage in their scenario. And what they do is they're saying, okay, if the investor gives me R1 million, I can go to the bank and get additional, let's say 500 or whatever it is, depending on the leverage that they go with, 1,000 rand. So now all of a sudden, my investment into solar is not 1 million, it's 1.5 million. And my deduction there, I just used in this case, in this scenario, 40% leverage, the investor would get a 2 million rand deduction. So he puts in R1 million, he gets 2 million rand as a deduction. His tax now is only on 917,000, which would be 258,000. So you can see, if he didn't do the investment, he pays 1.1 million. If he does do R1 million investment with leverage, he's only paying SARS 258,000. So immediately he gets 900,000 rand from SARS, which means the investment is costing him really 98,000, 10% of its value. This is just another example, but I don't want to spend too much time on this. The guys will go through their own models, but effectively you can see an investor puts in 1.2, there's leverage of 800, it's a 2 million rand, and he gets back 80 to 90% in the first year. As the years go on and the debt is paid off, so does the increase in returns happen. All right, I think that's the end of my slides. I'd like to call on Rainier to present Gaia's opportunity. Thank you very much.
Yeah, I think before we hand over to Rainier, so I just want to introduce Rainier for a bit, and just for 1 minute. So Rainier de Wit, we've been working with Gaia for the last 4 years, and prior to that in the Meta fund, it was in part of 12J. Yeah, Rainier, we've actually done a few private equity opportunities in the water space, Oasis Water. We've also done a agri opportunity, which is a 92-year-old farming group, which is permanent crops with the Rand hedge, and also a bit of fiber. So yeah, we actually have had a good experience, and Rainier is yeah, I think is really working hard in that business. Very interesting team, but yeah, welcome Rainier, and thank you for making the time.
Thank you very much, Anil and Matt, and thanks for having me, and good evening to everyone. I'm just gonna share my screen, make sure that we're able to see the presentation. Maybe I can just ask just a thumbs up that you can see it, Anil, if you don't mind, just to confirm.
It's perfect, Renu.
Perfect, good. Okay, so thank you very much. It's lovely to speak to you this evening about Gaia's Section 12B opportunity, specifically in the renewable energy space and predominantly in solar and batteries. Maybe just a little bit about Gaia and where we fit in. So we're a business that's been going for about 12 years. We were established and born out of a renewable energy developer. Our founders were developers of wind farms in the South African renewable energy IPP projects. So those big wind and solar farms that we see next to the road when we drive through either the Northern Cape or the Eastern Cape. That deliver power to the grid. And it's an owner-managed business. So the management and our founders hold the shares. We're not owned by a large bank or so. We've been pioneers in this space, and we've always been focused on impact investing, essentially investing in assets that are good for the economy, for the environment, and for the people. So we make sure that not only do we measure what the negative effects of the ESG aspects, but also what positive impact we're creating. We've been pioneers in this space in the South African environment. We concluded then the first secondary renewable energy transaction, where we utilized pension fund money in South Africa to acquire a wind farm from a Japanese developer. So that's quite an interesting transaction. And over the years, we've gone on to do 12 similar transactions. You'll see there, in terms of our pedigree, we've concluded nearly 750 megawatts of solar and wind assets at this point in time, and that keeps on growing. We invested in the N3 toll road, which runs from Joburg to Pietermaritzburg. We've done a number of fiber to the home networks that we hold. And then we also invested in the agri space and in decentralized water with Oasis Water, as Anil pointed out. We love to operate in the listed markets as well, where we've listed 4 funds up to now since 2015. Firstly, on the Johannesburg Stock Exchange, a business that was focused on a yield co, essentially delivering regular dividends to pension fund holders through the Johannesburg Stock Exchange, and then of late, specifically vehicles that target energy and fiber, and the latest one being Gaia Renewables REIT, which is focusing on commercial and industrial solar and battery systems, and essentially in the same space that we have here. And I'll touch a little bit more on that later. The team, strong engineering skills. We got about 8 engineers in the team. We got 2 CAs, CFA, as well as an actuary. I'm an actuary myself. And then we complement that with independents and experts in our investment committees and at our board level. Maybe lastly, on this, as I mentioned, we're impact investors. Gaia is a member of the International Climate Finance Accelerator Program. So in 2021, that program, which is sponsored by the European Investment Bank and the Ministry of Finance in Luxembourg, selected 4 fund managers globally to be part of the 2021 cohort, and Gaia was the only fund manager from Africa in that round. So we're on a 3-year journey with them, really to make us globally recognized impact asset managers, and that means that we have funds that need to meet the Sustainable Development Goals and to really report on those and make sure we don't do greenwashing and the like. And then lastly, our funds are all both finance and investment focused as well as impact focused. So in our very stringent and disciplined investment process, which goes from the screening of an opportunity through the due diligence that we put these assets through, our investment decisions, how we monitor and manage those projects thereafter, up to the point where we sell to a buyer at the end. It's both We look at it through a financial returns and risk management perspective, but also through an impact and ESG perspective to make sure that we've got both of those lenses. Guys, track record over the last 9 years. You'll see the track record on the right-hand side. This is a real graph. By real, I mean we've stripped out inflation, as Anil mentioned before. So Guy's returns on its portfolio has been inflation plus 8%, which is very, very healthy, in the region of 14–15% on a nominal basis. And I think really what this graph wants to show is the uncorrelated nature. So it speaks to exactly what Neil and Matt has said earlier about the importance of an alternative asset in your portfolio, the ability to have diversification benefits. So when you have a COVID event, such as what we had at the end of 2019, 2020, and you've got a market downturn, and we could see it in all of the indices, and specifically in the property indice, which was hit really, really hard by COVID, and obviously, you know, a revaluation of commercial property. Then you've got assets that are a lot more stable and defensive, such as infrastructure, and specifically the assets that we invest in here. We've got reputable investors and co-investors that you'll see on the left-hand side. So we're in good company in the assets that we invest in. Okay, so if we then just briefly look at the South African market, I often get questions as to why we don't have load shedding at the moment. Well, let's just understand why we have had load shedding from the start. And if you have a look at this graph on the left-hand side, you'll see Eskom's generation capacity. And currently, where we're sitting at 2023, with this graph tending downwards as our coal power stations are being decommissioned in South Africa, you see that we've got capacity of about 40 gigawatts in South Africa, but roughly, you know, on a good day, 60% of those power stations actually delivering up to their capacity. So in general, we're at about 25 gigawatts that we are generating. It's because our power plants are old. These power plants have been developed with a lifetime of 20 to 30 years, but we see that more than 30%, more than 57% of these power plants are older than the age of 30. So they're bound to underperform. It's the same as a very old car that you haven't really maintained according to specifications. And now after 30 years, you're still wanting to drive it from Johannesburg to Cape Town at 120 kilometers an hour. It simply is going to break at some stage. And that's what we're facing here. Can we not just connect more large wind and solar farms? The problem is our transmission network. The transmission capacity that we have is in Mpumalanga and in Limpopo and in the Free State, where the power plants, the coal-fired power plants are currently. So that's where the grids have been built, and not in the Northern Cape, Eastern Cape, and Western Cape, which is more where your renewable energy capacity is. So in order to connect large wind and solar farms to the grid and generate renewable energy, you know, at scale, you need to first upgrade your transmission grid. And that means that, you know, more than 14,000 kilometers of upgrade is budgeted by Eskom in the next 10 years. In 2023, the budget was 166 kilometers, so a small portion of that, yet only 77 kilometers was built, and it's not been energized. So we're a bit on a hiding to nowhere, and that really is where this opportunity comes about, where commercial and industrial players are able to have a better generation for themselves, their own electricity. And that comes to the next point, which is we've connected 4.5 gigawatts of installed capacity in private generation. So rooftop solar and on-the-ground solar, carports and battery storage for specifically commercial and industrial players. 72% of that going to commercial and industrial. And to be quite honest, that is the reason why we don't have well, one of the reasons why we don't have load shedding at the moment is because some of them, the larger users of electricity in South Africa have private generation. And it's because of for example, 12B funding being available. For Gaia specifically, we like to play in the commercial and industrial, that's the C&I space. That's a sweet spot for us, is between a 1 megawatt and 10 megawatts, which means that you've got an energy consumer, a company or a factory, a manufacturer, and the like, that consumes a lot of energy. They are very dependent on energy as an input. They can't go without it. They need energy security, and it's a decent enough system in terms of size for us to fund. Once we go above 10 megawatts, you're into the space where your large mines and many of the operators in that space, it's very competitive. And below a megawatt, and I'd say below 500 kilowatt systems, you're into the more bucky builders, lots of people operating in that space. So it's a sweet spot. Don't think it's going to be there forever, but certainly for the next year or two, we believe we can get credit-worthy off-takers in this space. I think something that makes the Gaia opportunity different from certainly some of the other operators is that we have a developer in-house, I guess we can call it in-house, which is where we have a right of first refusal on their projects. This is a team that has more than 80 years of combined experience in specifically the space, developing renewable energy projects for off-takers in the commercial and industrial space. They've got proven execution ability. And just to give you an example, in the last 2 years, they've seen over 700 different clients. More than 1,300 electricity bills have been analyzed. 200 proposals have been delivered to those clients. That means the pipeline of prospects is in excess of 6 billion rands, and the pipeline in due diligence and with power purchase agreements signed is about 1 billion rand. That is important, and that really is that funnel. And I used the example the other night of saying that if you're going to go and buy a house, you probably should look at more than 20 to 50 listings. You should go and view between 10 and 20 of those. You should make an offer on at least 5 of those to be able to buy one. And that really is to buy the right one, and the type of funnel and process that Blue Energy go through. Gaia then is the investment committee and credit committee on these transactions. Blue Energy brings the transactions to Gaia, and we decide which ones we're comfortable to fund and which ones we're not. And just on the left-hand side, one of the transactions that was recently announced is a 20-year power purchase agreement with the largest wheel rim manufacturer in South Africa. They manufacture rims for Ford, BMW, Toyota, and many of the other big car manufacturers in South Africa. And it really is a business that is energy dependent. They have to, be the smelters of a lot of raw materials. And if the power goes off, it really means a lot of wastage. So they are replacing coal power, not coal power, but diesel generation, energy systems and other energy systems with our system. The team at Blue Energy have more than 80 years of experience, as I mentioned, and it's a team that have developed Africa's first green energy exchange, nuclear engineers, heat engineers, developers of more than 250 megawatts of power, PV power plants, and right down to the end client that they manage, which is Andrew, as an example, was the previous CEO of iTech. So they understand office automation, equipment, financing for those offices. The pipeline, we've selected 7 opportunities specifically for our 12B fund. 210, and it's 210 million rand, and it's spread across a number of industries. You can see the manufacturing, processing. By processing, we mean it's taking raw materials, specifically in the agri space, and then in forestry and so on, and processing that to an end product. Agribusiness, so large pack houses that consume electricity and farm to pump water to the orchards right throughout the year. Light industrial, and then financial services, which is a smaller opportunity. And there are many more like these. We've specifically selected these opportunities. Okay, I'm not going to spend too much time on the illustrative example in the interest of time, but maybe just to say that, you know, as Anil set out earlier, so not Anil, but Matt set out earlier, if for R1 million invested, we add debt, so on a 60% equity, 40% debt basis, to bring your total investment to 1.7 million rands. Then with a Section 12B deduction of 125, we essentially are able to produce a tax incentive of 937,000 rand. So 93% of the money that is invested is de-risked in the first 2 years through this, and then obviously we add onto that the income that we generate. And what does it mean for you as an investor? It means, if you look at on the right hand side, in the first 5 years, a yield on the investment of R1 million of roughly 10% per annum. That's pre-tax, so you'll have to pay tax to SARS on that. A return of 18% then in the next 5 years, and then it reduces a little bit thereafter. I think an important aspect to mention then is part of how we work with Blue Energy is to make sure that they develop the right projects at the right tariffs and yields, manage those, because at the end of the day, they receive their upside after year 10. So we keep our developer interested so that they can earn at the back end, and it means that they are really there to manage these assets optimally, to make sure that we collect the income. The systems are there to produce for 20 years, so that at the end of the day, they earn when we earn as investors. Okay, so you cash flow positive and de-risked in year 2. Essentially, if we add up the pre-tax cash flow, it brings a multiple of 3.7 times the money that you invest. So that's over a typical 15 to 20 year system, power purchase agreement. And the IRR pre-tax comes to 37% and post-tax at 20%. We make a few assumptions in that, as you'll see at the bottom there, but those are sort of economic assumptions. And I think the important thing is that our income and our, you know, what we charge our end clients increases as inflation increases, so you've got inflation adjustment in that as well. The on-common partnership was explained by Matt, but very simply, as investors, you invest through a partnership agreement, which is managed by Gaia. We add to that some of the debt provided by our debt providers. And then we have power purchase agreements with our end clients, where we put down the solar PV as well as battery energy systems to make sure that they are de-risked as end clients from load shedding and price escalations above inflation. So, and then Blue Energy, as I mentioned, develops those systems and manages them. And then we've got engineering and construction companies, our EPCs, and operations and maintenance teams that are outsourced, that we've got agreements with. Okay, maybe just it's important to speak about risk. I think we've summarized on the left-hand side some of the risks that are in a project like this. I think it's important to know that, you know, as we've said, you have to take risk. But it's important to understand that risk and then to understand how we mitigate it as a team. So just on the deployment side, we've got a team of expertise that have done this. We've got a pipeline, so the chances of us not being able to deploy it are significantly reduced. Credit risk, we only select blue chip clients. As I mentioned before, it goes through a rigid credit assessment process. And then we select clients that are essentially already paying the electricity, and we're replacing that payment that they're paying to Eskom with a payment that they pay to us. But because they are high energy consumers, they must pay this, and it's important for them. Performance risk, we monitor it, literally by the minute, live monitoring and performance. The Section 12B tax risk, we've got a limited capital raise. We're only raising 100 million rands of equity capital, which will add debt to, because we've got a deployable deal pipeline that we can deploy on in the next 6 months. Gearing risk, as I mentioned, we're not over gearing it. And then I think important is that you'll have some diversification in this project. So the 100 million plus debt, so call it 150 million that we'll raise, we'll invest that across 4 to 8 projects. So a bit of diversification by offtake as well. Liquidity risk, an important one. So periodically, every 5 years, we would provide an opportunity for exit, which you as investor could then evaluate. And because we have Gaia Renewables REIT, which is a listed platform, we have an off-taker already there, which is raising capital on a continuous basis and can buy these projects. Okay, and then just on the key funding terms, this is in our brochure as well. Our minimum investment being 500,000 rand per investor. The management fees at 1.5% per annum, which is I think market standard or below market standard. We earn when you earn, and I think that's important because we get it's important for us to make sure the income is distributed to the LPs, and we earn when you earn at that point in time. Semi-annual reporting, and I think the rest of the items are industry standard in terms of what you would expect from a 12B fund manager. Okay, our capital raise is ongoing, and please speak to Anil and Matthew about how we make those investments. We're raising capital, and then we would have drawdowns on that basis. So we would send you a drawdown notice, and you'd have more or less 2 weeks to make the investment then into the fund. Okay, I think I'm going to stop there.
No, thank you, Ranier. Yeah, no, it's always great, and we're on time, so well done. Lovely to hear you present again, and looking forward to what we can raise for you guys. Yeah. So now just to introduce Jonty Sachs. He's director at Jaltech Fund Management. So Jonty's been around for a while. They've done 12J in the past. On those funds, they were very moderate risk. They were very conservative in those funds. But recently, there's a party, Capital Partners, that bought a pretty decent stake in Jaltech, and they really believe in the Section 12BA opportunity. And yeah, they've actually lifted the team by about 10, 11 people. And I think when it comes to the solar side, they really got a strong network of different EPCs and operators that they can work with. They put a lot of effort last year. And I think the team-wise, there's also ability to execute, which is quite great. So without further ado, Jonty is an attorney by trade. There's also an actuary there alongside him, a couple of actuaries, and now I know a few CAs, and very interesting team, and a young and dynamic team. So Jonty, over to you, all of us.
Neil, thank you very much, and everyone, thanks for attending. You know, the attendance today is very impressive, in fact. So thanks for attending, and if you've got any questions, please, engage with us. Put them in the chat section, and we'd really love to answer them. So I'm going to share my screen with you, and I will take you through our current proposition in the market. So, what I'm really going to try and articulate as clearly as I can is, one of the big allures by investing into our first fund is that we've got a lot of time to deploy the capital. And because we've got a lot of time, we'll be raising debt in this financial year and looking to deploy the debt in this year. And what I'll show you in a couple of slides is that what this means is potentially you'll be able to receive up to 90% of what you invested back in the first year. So if you give us 100 Rand, if you're in the highest tax bracket, you should look to receive 90 Rand in the first in this first year of investing. And I'll show you the numbers shortly. So that's really the big allure. By investing later in the year in our second fund, your risk around non-deployment becomes material. So this is really the premier fund to invest in. We are fully allocated. So Innovate has an allocation. We are basically done with our fundraise. So if you are looking to invest, you have a couple of weeks to do so, but I'll touch on that in a few slides to come. So a bit of background. We manage over 2.5 billion rand of investors' capital. We're an alternative investment fund manager. And Neil mentioned Section 12BA. We have a crypto fund which is growing, but solar has really been grown into a core focus of our business. So we're very, very focused on solar. We've got 1,700 investors, and in the solar market, we've in the last year financed 27 megawatts of solar projects, over 365 million rand invested, and over 159 solar projects. I think we're at about 165 at the moment. But it's our track record which should really impress you. So our first fund, the average yield which we are generating for our investors is around 17%. Exactly the same for our second fund, and the IRRs are identical. So, these funds have really been invested. 100% of the capital is now deployed and generating returns for our investors. So we've got a really fantastic track record in the market already. And we've got exposure across many sectors, as you can see on the screen: property, education. We've financed many solar projects throughout the country. And then really going on to today's investment is our investors who invest with us, they're going to get a long-term exposure in the market. And our mandate is to identify commercial and industrial energy consumers and then enter into long-term contracts with them. We want to take investors' capital, buy solar equipment, install it on large companies' roofs, and then sell them electricity. And how we do this is pretty simple. We have a massive network of solar installers. More than 50 generate business for us and bring their clients to us. We'll review the client. If we're comfortable with the client, we'll provide them with 100% of the capital needed. So we'll finance the entire solar project, and then solar installer will then do the installation and maintenance for the duration of the contract. And really what we are doing is we're competing with South African banks. But we're way more competitive for a few reasons. One is banks will only finance 70% of the asset. We want to finance the entire asset because our investors get a tax deduction. Banks can only finance for 5 to 7 years. We can finance 10 to 20 years. And that is a real game changer in this market, because if I had to lend someone R1 million, and if they had to pay it off over 2 years, the annual cash flow would be high in order to pay me back. But if I had to finance it over 20 years, that same amount, the annual payments are a lot smaller. Yes, there's more interest over the period, but the annual payments are a lot smaller. And when you quantify that annual payment into an electrical tariff, in other words, how much we're selling electricity to, we are significantly cheaper on an annual basis than Eskom. To give an example, we quoted on a project recently where the end consumer was paying roughly R2.50 per kilowatt. We could finance solar at 99 cents. So it's a real no-brainer. And that's because of the long term that we can offer and a deal turnaround time. If you work with a bank, even in our space, we raise a lot of money from local banks for our investors, and it takes 6 to 8 months. In the solar market, a solar installer can't wait 6 to 8 months. They'll lose the client. If they come to us within 2 to 3 weeks, we could potentially finance the entire project. So we're young, we're nimble, we're energetic, and we're really hungry for the business. And I'll give you a sense of what that looks like in terms of pipeline in a few moments. Now, I mentioned this 90%, and it really is not because we are the smartest fund managers in the country. It's really because there's a once-in-a-lifetime opportunity to take advantage of a really enormous tax incentive. This tax incentive is only available this financial year at the current rate of 125%. This is the last year that it's available. It was available last year and this year, and then next year it may most likely revert to 100%. So at 125%, this is your last opportunity. As Matt explained, if you invest R1 million, if you're in the highest tax bracket, that equates to a saving or a refund of 562,000 Rand. Okay. So if you invest with us, you'll get a tax benefit of 562,000 Rand on your investment. We then raise debt from a bank at a rate of 2-to-1. For every 2 Rand you give us, we are only raising 1 Rand of debt. So it's a very low ratio of equity to debt. So in this example, if you gave us 1 million, we would raise 500,000 Rand of debt. We would use that debt to buy solar. Because you're an investor, the ownership of that solar reverts to you, and you can claim a tax deduction on the 500,000 Rand. 500,000 at 125% will give you a tax benefit of 289,000 Rand. Again, this is no smart from Geltech. This is literally really expanding on the benefit as much as we can. And if you combine those two sums, you get 850,000 Rand in tax savings. And in this year, we'll look to return some cash flows to our investors. And the combined value is approximately 900,000 Rand, which is 90% of the investment value. That's if you're in the highest tax bracket. Now, really what I'm saying is you're now being de-risked by 90% in the first year, and then you're generating a return on the 1 million Rand, but you only have at risk 100,000 Rand. This 850,000 Rand that you're receiving, if you don't invest with us, that's what you'll be paying in taxes to SARS. So I like to say to people, you have 2 options. Option 1, invest, for example, 1 million Rand with us and receive 850,000 Rand. So you have an investment of 1 million and you have a refund of 850,000 Rand. Your alternative is don't invest and pay SARS 850,000 Rand. So in other words, I'm saying if you rather than paying SARS 850,000 Rand, rather invest a little bit more than the 850, 1 million, and don't pay any tax. So you can either invest or you can pay tax. By investing, you'll get a return. By paying SARS, I highly doubt you'll get any return at all. And I'm sure we can all vouch for that. So on the screen is the cash flows that the investment is looking to generate. So again, the example is if you invest 1 million Rand, our minimums, by the way, is 500,000 Rand. But if you happen to invest 1 million Rand, in the first year, you'll receive 562,000 Rand as a refund from SARS. You'll receive some cash flows. Because of the debt, you'll receive another refund. And if you look at this line, what you're seeing in your second year is that you projected to receive around 72,000 Rand. And what I want to explain is in year 1, you receive 63,000, which is 6.3%. In year 2, 7.2%, then 8.1%. And what I'm trying to illustrate to you is that your returns annually or your yield annually goes up. And the reason for this is when we sit with a potential energy customer, we need to price our electricity at a rate which is low in the first years, and increases over time at 6% compounded. And the reason we do this is because we need to be cheaper than Eskom in the first few years. And as Eskom increases, this year was 12.72%, we were 6%. As Eskom continues to increase at a high rate, we'll continuously be below Eskom and be cheaper to the end customer. And that makes our offering extremely attractive. And as a result, we've seen enormous amount of deal flow. So what you're seeing here is the rates increase over time. And in the 10th year, there's this large bullet payment. Now, the assumption here is there are future cash flows around 3 years, which will then sell to one of the local banks, which is very, very common in this space, is if you've got an asset and that asset generates income and it's over a contractual term, you can sell those future cash flows at a discount to many institutions in the country, including banks. All the income that you're seeing in front of you are pre-tax. And what you're seeing on the right-hand side of the screen is the payments we are making to the banks. So if you add these two amounts, that's the the yield that we're generating. So in year one, you'd add the 63 and the 28, which would give you 91,000 Rand. So it's generating a 9% yield, but we need to pay the banks off. So that's why the yield is a little bit lower every year. And if you look at the bottom of the screen, this is the type of internal rate of returns we're looking to return. Pre-tax with a tax benefit, 49%, after tax, 23%. And the reason why these returns are so high, and again, it's not because we're the smartest fund manager in the room, it's because of this massive tax benefit, which we think investors should take up. The next slide is the same returns, but some investors aren't comfortable with our assumption in year 10, and they say, you know, what happens if you don't sell those future cash flows? Well, then you'll just be in for a few more years, but what you'll see is year 11 and 12 and 13, we've paid off the banks. So the yields are really much higher, 26% in year 11, 28% thereafter, and the final year, 48%. And that's because there's no debt to be paid, and that's really the end of the term of these power purchasing agreements. What we haven't taken into account is wheeling. That's where we have excess electricity and we sell it into the grid. We haven't taken that into account, and we'll look to generate income for our investors from wheeling in the future. Where we are in the midst of signing a deal, and literally today we're at the final stages of negotiating for our investors, and that's the carbon credits. We will own the carbon, our investors will own the carbon credits, and we're hoping that that will generate between 0.7 and 1% per year for our investors as an additional yield, and that has not been added to the numbers. But this investment, as with any investment, is not without risk. So the first risk is deployment risk. If you give us 100 Rand, if we only invest or finance with 50 Rand, you'll only be able to claim a tax deduction on the 50 Rand that we've invested. This risk is material for investors who are investing in this time of year. You're at the lowest risk level. That's why I mentioned earlier, this is our premium fund. Investors who invested with us last year this time, we were fully deployed into assets. If you invest with us later in the year in our next fund, that risk is higher. We've done an exceptional job in terms of our deployment pipeline. We've signed term sheets with large solar participants, more than 15 term sheets, cumulatively giving us a first right of refusal in terms of business that they generate to over 1 billion Rand. So if these 15 solar participants generate business, they have to give it to us first, and then we'll see whether we want to finance it or not. But over and above them, our team has priced this year, and what I mean by priced is solar installers bring us an opportunity, one of their customers who want debt funding. We will then do a indicative pricing proposal. This year we've priced over 3 billion Rands worth of solar projects. In May we priced per week 155 million Rand per week. In June, we had about 145 million Rand per week. So we're seeing huge deal volumes. We anticipate maybe to close 10% of the deals already priced, which is a considerable amount of money. In the last 6 weeks, we've already approved 106 million Rands worth of transactions. So our deal flow has really materialized. We worked really hard on it. And the reason why we're so confident that we can deploy capital is because we have a very large team devoted to solar. So the people you're seeing on the screen, they are just in the team and focus on solar. So the team is headed up by one of my partners, Derek Hyde. He's an actuary. He's supported by 5 transactors. These are chartered accountants who've got years of experience in doing transactions. And I'm supported by 3 business developers. We meet with investors. We meet with solar installers. And then importantly, we have 3 full-time lawyers. These lawyers assist with all our deals. The amount of legal agreements in place for every transactions and for all the transactions we're looking at is so huge that we just couldn't outsource this business to a law firm because they've got other clients that they need serviced. And we're running out of time. So we've had these people in our business working with us full time, and it's really been game changer for us in order to be able to deploy the capital that we're looking to deploy. So the first risk is deployment risk, and I really think you're at your lowest point in time now if you were to invest. The second risk is credit risk. The people or the companies that we're providing selling electricity to, can they service their obligations to us? And you know, the fact that we've done already 3 billion rands worth of pricing should give you a sense that we're already seeing the cream of the crop. And we can then be very selective in terms of who we do business with. And from our side, this is a long-term investment. It's 10 years. We don't want to be doing deals with businesses that are iffy in terms of their ability to meet their financial obligations. We want to really provide healthy businesses with electricity at a cheaper rate, and businesses who we know are gonna pass, so that we can provide our investors with the returns we anticipate. Debt funding, our ratio is low, 2 to 1. And critically, our debt provider can only has recourse against the solar assets. So if, you know, something terrible happens and the investment goes to zero, the debt providers can only go after our solar assets and not after our investors. But to that point, the debt ratio is very low, and investors have huge diversification. You'll have exposure to 15 to 25 different solar projects on different businesses. So diversification is key. And then Section 12B risk. By investing in with us, you have exposure to Section 12B, and that is a requirement that you need to be at risk for what you've invested with us, and 25%. And if you're not, then you don't get to enjoy the tax benefit. And the investment highlights, our minimum investment is 500,000 Rand. I mentioned we're looking to return 90% in year one. Your investment is asset backed. If a company doesn't pass, what we do is we'll collect the asset and we'll place the asset somewhere else. We will lose the opportunity costs or cash flows we could have generated in that period, and other losses of installation costs, etc. But there is an asset which will not disintegrate. We can go and deploy it somewhere else. You exited every year through distributions you're being received. The IRR is really high. We've got a fantastic track record in this market. We have a fundraising cap, as I mentioned, and you really invest with us for 10 years. In terms of our fees are 2.25% per year, and our performance fee. Our performance fee is 20%. It's calculated on an annual basis, and it has a high watermark and catch-up. And if I can explain that in simple terms, what we do is once the money is invested, we look at our average term, how many years we've signed contracts for. So let's assume it's 10 years. If you invest 100 Rand with us, we'll take 100, we'll divide it by 10, and that will give us 10. And every year, if we don't return at least 10 to you, we don't earn a performance fee. So let's assume in year one, we return 12, we receive a performance fee on 2. If in the next year we return 8, we don't earn a performance fee, and the following year we need to catch up on what we missed out in the previous year before we earn a performance fee. And for us, having an annual performance fee is critical. It's a long-term investment. As an investor, you want us incentivized on an annual basis to generate these returns so that you can enjoy the cash flows that we will be paying out on an annual basis. And then lastly, our investment closes at the end of this month. Innovate has an exemption till the middle of July. So you do have time to meet with Matt and Anil, and I'm very available to be in those meetings or subsequent meetings if the need be. Thank you. Thanks everyone for your time. I see there are lots and lots of questions, so be happy to deal with them.
Yeah, thanks so much, Jonty. Appreciate that. So the good thing is that we're on time, and like similar to the live event, we had so many questions, which was really interesting. And I think we had to go to half an hour that day before we had to force the close. So I'm just going to start from one side, and then I'll go into I'll ask the relevant speakers to comment. Yeah. So I'll go in the order of how the questions came. The first question was by Devin Chetty. His question was, Geltec hasn't done so well in the past 12J, and why do we trust them now? So yeah, I think Devin, I did share this when I met you last. So one thing with Jaltech, they had a moderate risk profile in the last investment. It was more asset rental business. And I think in COVID, they were very conservative in investing in any asset where they could lose any cash. So there was that, and that affected the returns. I think when it came to the 12B side, the capital partners, taking 51% interest, really building the team. And last year, I think when it came to deployment, they're one of the best performing 12Bs in terms of getting the money deployed and also at the right terms. So yeah, I think, Jonty, if you can just ask quick answers. I've got about 11 questions, by the way.
Right. Yeah, I think, one thing we don't do in our company is just make investments for the sake of making investments. So in our section 12J investments, we don't have a single investment that we've made that has lost a single cent of our investors' money. So all the investments we've made have done really, really well. Maybe our investors aren't getting the 20 or 30% returns they had made wanted, but what we've done to date is we haven't lost a single cent of investors' money. So we're very conservative. We're not going to just place money into various opportunities. We'd rather be very calculated, whether it be with 12J or with 12B. We're not in the business of just simply making investments. We are very careful in the investments that we do make. And where we've made investments, they've done really, really well. So, if the expectation was high, well, I'm sorry that you're disappointed. But what I can tell you is your money is very safe with us. Anil, how would you like to deal with the questions that have been proposed?
I'm gonna ask the attendee if they want to. I would appreciate if you can answer on the Q&A if you're happy with the answer, or we have an option to unmute. Okay. So, Devin, the next question that you asked is this based on a proper rollout to get maximum benefit? So I'm trying to keep the answers short, otherwise we're going to have a long session. So I think the main thing is that you have to have the money deployed to get the full tax benefit, and the second part, from a yield point of view, you need good quality clients. There's a long period, of assumptions, like 13 years to 20 years, depending on Jaltech or Gaia. And there's also options to exit. So yeah, I think that's really the two parts. One is the tax benefit, you need the deployment. Does that answer your question, Devin, or would you like to unmute? Kala, you can allow Devin to unmute if he just wants to say. Is your question answered, Devin?
All good there, Anil. Thanks.
Okay, thanks very much. The next question was by Fawaz, and there was a similar question by Sudhir. Will the session be recorded? It has been recorded and it'll be available for all the attendees post the event. Yeah. And we will be sending also some of the slides. Okay. Now, Fawaz, that's good with you. Then there was a question by Sudhir Ramdas. How does the performance fee structure work? And what total time horizon do we look at? So I'll just give you a quick answer. Obviously, on the performance, Jaltech is 2.25%. Annual fee, Gaia is 1.5%. And the performance is effectively, on Jaltech, there's a watermark, but effectively they take a 20% performance. And in Gaia side, they take 15% distribution. Every time they distribute to a client, they will take, the client receives 85% and the investor, so the investor receives 85% and they would take 15%. Do you guys want to add anything, Jonty and Gaia? Renier?
All good, thanks.
Renier?
Sorry, I was on mute. Yes, that's fine, Anil. Thank you.
Okay. So did you answer your question? There's an option. Sorry?
I did answer in the Q&A, so.
Oh, you did answer. Okay. So does that answer your question, or you still want to? We can unmute you if you like.
Yeah, no, that's fine. Thanks. I get it. Yeah. Thank you.
Okay, great. Thank you. Yeah, there was a lot of other questions in the live event also, which is quite interesting. I'd like to expand on a couple of things. The question by Vishal Gilani was, please expand a little more on the diversified portfolio projects with Gaia. Maybe Matt, you can bring up the screen with the projects and Renier can talk through it. Matthew?
Maybe I can just start in the meantime. So what is important for us is that, you know, and I think Jaltech is similar, is that you want to give your investors exposure to a number of projects, right? And this is based on having diversification across a number of clients, a number of sectors. You want to minimize concentration around a specific area, which might then be more affected by a specific economic event. Let's take property as an example. Property was really, really badly hit by COVID, naturally, because you had people working from home and leases being terminated. So similarly, we like to invest across a number of different industries. So you would see that we've selected 5 industries where we have got projects that have PPAs, power purchase agreements, already signed or are very close to that, so that we can conclude those in the next 6 months. And essentially those are manufacturing, processing, agribusiness, light industrial, and financial services. There are a number of other areas as well. So we got a few of the smaller mines. We have a number of farming operations, but we believe that these are assets that probably fit the mandate of 12B the best. And you can see our transactions are on average between 20 million Rand and 40 million Rand in size. So that's the capex that is needed. And by having a bit of a spread across a number of industries and a number of end clients, you're creating diversification in that portfolio itself.
Thanks, Renier. Yeah, I think maybe, Vishal, just to answer further on our side, when we did the DD, what we like is the blue chip clients, because, you know, the quality of clients determine, you know, the period of time whether they'll pay, you know, for 20 years, and assumptions are changing also over time. And the second part is that they also have quite a bit of experience in some of the processing stuff in agri businesses. So, yeah, there's a lot of experience there, which also helps and brings that quality of client. I think the one agri business is a pretty sizable, it's multi-generational company. Does that answer your question, Vishal? You can unmute if you like.
Yes, Anil and Renier, thanks for that. Much appreciated.
Okay, cool. All right, the next question I have from Dr. Zanile. He says, explain what 9 months of de-risking means. So I think a lot of people, just to unpack this, you know, our role is to make sure there's transparency. So if Dr. Zanile, if you're a provisional taxpayer and you're paying tax in August and February or whatever your year end was, twice a year, you can actually deduct from your provisional tax an estimate of what deduction you would receive, which we've done for all our clients in the Feb 24 year, for example. We gave that for the accountants to provide for that deduction. Matthew, you can take off the sharing, if you don't mind. Yeah, so that's the scenario. So provisional taxpayer, you get the benefit immediately. The main part about this, the money has to be deployed. So the key thing is that right now, Gaia and Jaltech are kind of front-ending the whole thing, where leaders have been getting started much earlier than some of the other houses, with a view that they want to make sure it's deployed, which is something we had as a risk last year, especially when people start putting the money in October or November. You get into the December holidays and the money is not deployed. Yeah, but the de-risking means you can do it on provisional tax. A PAYE person will submit the return. They've already paid the tax in PAYE, and when they submit the return around July to August or whatever, they can then submit the return. There's a section in the income tax return which says partnership deduction and also income. Accountant will fill out that, and then based on that, you have entitled to the deduction. Remember, it's in the Income Tax Act. So although the administration at SARS sometimes is a bit up and down, they do honor, the Treasury is one of the best run departments in our country. Hopefully that answers your question. And generally you de-risk by year 1, year 2. I think it's not 9 months. The tax gives you 85 to 90% on these both examples. But you de-risk your capital by year 2. Maybe it could go to year 3 if there was some delay in the yield. Dr. Zenile, does that answer your question? You're unmuted, Dr. Zenile. I think. Hi. Okay, I think we'll come back to him if he has not.
Yes, thank you very much for your answer. So basically what I mean is the de-risking itself is dependent on the yield of the capital amount that you've given. So it would also depend on when in the year you have given it. So say you've given it now in August, you expect that by say February next year, you've sort of gotten the tax deduction, or rather tax incentive that you're hoping for, compared to if you put it in around December or so, where the yield might not be so great and could take 2 to 3 years for you to get that same. Is that what you were saying?
No. I think let me just unpack it in an example, Dr.
Okay.
Zenile. So let's take an example. Let's say you're a provisional taxpayer and your taxable income was, let's say, 5 million. Okay. And now you do an investment for R1 million. Okay. So in the example of Gaia, they take some debt on that million, and as you saw in the Renewa's presentation, you get a deduction for 2 million. Agreed? So now automatically the actual taxable income for the February 25 provisional will be, instead of paying 5 million for the year, it will actually reduce to under 3 million, just slightly under 3 million. So now your provisional tax will be automatically reduced. So that first part, the return on investment, is coming from the tax reduction in taxes, or the refund. In this case, reduction in taxes. Instead of paying on 5 million, you'll pay on 3 million, which means you're going to save close to 900 and something thousand rand tax on that R1 million that you put in. Do you get that first part? And then the yield starts usually from the time the money is deployed. So usually it will start in the Feb 26 year. Some yield could come in the current year, especially for the ones that are investing now. But most of the yields will start from the Feb 26 year, and your first yield will come in August, and the second yield will come in February 26, August 25, Feb 26. Yeah, so like Gaia's yield is 10%, so you expect to get 5% every 6 months for the first 5 years, 10% every year. And in Jonty's case, that first return is 6% and goes to 7 and 8. Their models are slightly different, but their returns are pretty strong overall. That's what we mean. So you take the tax deduction, which is the immediate return on investment, and the yield, and that's what we're saying we de-risk by year 2, year 3. Hopefully that answers your question.
Yes, certainly. Thank you. Thank you.
Okay, super. Thanks, Dr. Zenile. Shanaz Pad asks a question: provided full deployment, how much certainty is there regards tariffs that will be charged in the future? Are these contracted? So I think I'm going to put this straight to the panel. So the question is, provided full deployment, how much certainty is there regarding tariffs that will be charged in the future? Are these contracted? Obviously, it is contracted. So I think, Jonty, if you can ask a quick answer, and Renier, if you want to add to it. Yeah. Thank you.
So, the simple answer is it's irrelevant for us, what happens in the future with Eskom. So at the moment, as far as I'm aware, that Eskom have proposed potential increases for the next additional 2 years. Whether they get that from NERSA or not is a different story. Why I say it's irrelevant is because we contract in this year for 10 or 13 years with energy consumers. So we lock them in now, at a rate which is now, depending on the mixture between solar and batteries, but typically is cheaper than Eskom now. So they're very happy. They're then fixed into that rate, escalating at 6% for the next, say, 10 years. If over the next 3 years, Eskom starts becoming cheaper because they got excess supply, it's really irrelevant. We've signed long-term contracts with them, and they need to honor those obligations. So ultimately, it's very everyone in the market is very certain for the next 3-5 years, Eskom will continue to increase their rates, making our proposition really attractive. If they don't, again, as I said, it's unfortunate for them. They're signed in for a long-term contract.
Renier, you want to add anything onto that? Thank you, Jonty.
Yeah, no, I mean, Jonty's spot on. It's exactly the way we look at it. I think maybe let's turn the tables a little bit, and let's say that you are a energy consumer and you're a client of ours. You're the financial director. The one thing that you don't have at the moment is certainty about what your electricity is going to cost and how much electricity you will get from Eskom. So with these energy systems that we put in there, you've got a higher level of certainty about the amount of kilowatts and megawatts that we'll generate. So there's energy security. Secondly, you've got certainty about the price that you're going to pay. So, there's an inflationary increase, it's inflation plus 1 or 2. And that inflationary increase is contracted for the next 15, 20 years, which means making budgeting of a really important expense on your income statement a lot easier and more predictable. And that's why energy security coupled with cheaper tariffs than what you're currently paying and predictable expenses into the future is a much better proposition for these clients.
I'm going to continue with Shanaz because she asked another question, Renier. The question was, can you provide more detail on Gaia's tax opinion regarding the tax deduction? Obviously, we've done the DD on this, and Renier, I've asked you this 2-3 times already on Gaia's investments spread over 2 years. And how much confidence do you have that the second year's deduction will be permissible, particularly if the 12B is discontinued as expected from Feb 25? Just be aware, Shanaz, that 12B may still be applicable, by the way. So it's not like it's totally not applicable. That's a continuous one where you can claim over 3 years, or if it's under 1 megawatt, you can claim under 1 year. So be aware of that. Renier, a quick answer on that, please.
Yeah, it's really actually quite a long answer, but I mean, there was a binding ruling that was produced by Sars earlier this year, which related to specifically the treatment in partnerships such as this, where they say that the maximum deduction that you can get in a year is capped at the capital at risk that you have. So our tax opinion essentially says that you can't get the 125 of your capital at risk, which is essentially the capital invested and the debt added to that, and deduct that full amount in year 1. But certainly that you'll have the tax deduction. You just can't claim it in year 1. You can claim it over 2 years then. So it's a slightly more conservative view that we've taken. We would certainly press to be more aggressive, but at this stage, that's how we are illustrating it.
Okay. Are you confident to get the deduction in year 2, the balance of the 25%? Renier?
Yes.
100%.
Yes.
Okay. Shanaz, does that answer your 3 questions you had? You're welcome
it's
to.
Ricky, using my wife's laptop. So
Hi, Ricky. How are you?
Yes, I am comfortable. Thank you. I think there was another question that I posed.
You said, yes, the question was regarding the debt side.
Yes.
So I can answer that question quickly for you. So generally, as a rule, the income tax is on the partnership income, which also includes the debt part. So you would pay on the debt income also, but then there's also an interest deduction for the debt, the interest on the debt and any other expenses including the management fees and related fees. And to answer your question, as you've seen in Geltec and in Gaia, they actually provided for the debt repayment from the income that comes from the partnership. In Geltec's one is pretty expressive. It shares this is the income like 9%, and then we're paying the debt, and your return in year 1 is 6%. And as the 10 years goes, the debt gets repaid. Do you want to add anything, maybe Jonty and Renier, very quickly?
I'm happy with that.
Another 7-8 questions, yeah. Renier, you want to add anything?
Good on my end as well, Anil.
Okay, all good. And does that answer your question, Ricky?
Yes, thank you.
Okay, super. Anonymous asked the question of 250,000 in solar assets, Feb 23 versus Feb 24. I'm just going to take an example of R1 million just to make it a little bit easier for people to understand. I think you said 2023 year and 2024 year. I'm assuming you mean Feb 24 year end and Feb 25 year end. Yeah. I did share this with Dr. Zanile earlier. So if you took R1 million, you're going to get that tax deduction either as a provisional tax reduction or a refund from PAYE that you paid in advance. And then you're getting the yield from year one, let's say Feb 26 as a conservative measure. And then going on for, in Jaltric's case, could be 10 years or 13 years. And the same with the Gaia could go on for 20 years. There's potential to exit on both of them, especially on Gaia, because there's a REIT that they can sell to, or they can get debt and repay your capital at some point. So there's some liquidity events that could be announced. Yeah, I think that's this quick. I have answered this with Dr. Zanele, so I think does that answer your question again, Anonymous? Have you unmuted, Carla? Yeah, we don't know who Anonymous is, so we'll have to move on there. The next question was from
sorry, it was me.
Sorry, who was
Sorry,
that?
Neil. That was me, Vishal.
Oh, yes, okay.
Yeah,
Does that
it
answer
was
your
more
question?
related. Not really. It was more related to someone that obviously can't put R1 million at one time, but obviously looking to put 250 per annum. And I wanted to see what the effect of that was with the rebates.
Now, the rebates are exactly the same. So the applicable rules for Feb 24 and Feb 25 year end, that means
It would work
March
exactly the same.
exactly the same. Yeah. So
Okay.
you get basically a tax deduction on the total solar and alternative energy deployed in that year. So this is where if the house took on debt, you also get a deduction on the debt. Yeah. Hope that answers your issue. Okay, cool.
Got you. Perfect.
Thanks. So you were
Thanks.
Anonymous and Mr. Gilani in one meeting, huh?
Yeah, I pressed the anonymous by mistake.
No, very good. So Naveen is a
Fine.
chartered accountant. By the way, he asked a very interesting question. So he says projections are really impressive over 10 years and greater. Obviously, when you have a long period, his questions are relating to assumptions and how is technology efficiency and impairment mitigated in view of the fact that obviously things can change. Do you want to just take it directly so we save time? I'll ask Renee first and Shanti second. Yeah.
Yeah, I hope I can remember the whole question, but essentially what we have to understand in terms of technology is that we're working here with solar panels and batteries. In both cases, there are warranties warranties in place, and you have to make sure that you maintain those systems according to the specifications in the warranty booklets. And our operations and maintenance team, together with our management services team, make sure that contract is that warranty, that's your best asset at the end of the day. You got to make sure that asset is maintained according to the specifications, because at the end of the day, if something happens, then you can claim against it, but you have to prove that you've maintained it properly. There's a whole methodology in terms of how you do that and how you capture that information. So specifically, if your solar panels stop working and you've maintained them appropriately, you invoke the warranty and you can have those panels replaced. Most times the project plant is spec'd above what is required. So, you typically 10-20% over-spec'd to make sure that you can meet those requirements. And that means that the technology, which has really been around for the last 20-30 years, which is proven technology, can last for the 20-year period. In terms of credit risk, right, at the end of the day, we do the work up front through our credit committees to make sure that the clients that we take on board and where we put these systems have been there for generations, as Anil has said, have been there for 20-30 years in the past. We take a view on the industry. We take a view on their positioning within the industry to say that what is the likelihood that this client is going to survive for the next 20 years. In essence, you've got a 20-year marriage with your clients. And if we're not comfortable that that's the case, then we probably won't enter into the transaction. Just to say that we still have an asset that you can go and wheel through the grid to another client. You can sell the electricity back into the grid, or you can take your panels and go and deploy them elsewhere.
Yeah. Okay, cool. Thanks, Ranir. John, do you want to add anything on that on your side? I think the main question, from what I understand from Naveen says, is that let's say technology changes or regulations changes with Eskom, how would that be addressed, Jonty? Like from an impairment point of view, or like how would that be? What is the mitigation that you can have in relation to that?
So technology change, again, it's irrelevant to us, so and let me explain that. So if new batteries came online, which were much cheaper, produced or stored energy for a lot longer, it's irrelevant, because our end customers who sign with us, we agree on technology today. We say, these are the panels, this is the brand of battery, are you comfortable with it? This is what it will produce, how many kilowatts per year, are you happy? You're happy, great. 6 months later, if technology changes, it's irrelevant. As long as the system produces what they expected, then they have nothing to complain about. They're again in for a 10-year contract, and then they need to service, the contract efficiently. And just like Ranir mentioned, we would only finance over the warranty period. So if the panels are 20 years, we wouldn't finance for 25 years, only for 20 years. And then around changes in regulations, our contracts are very clear. Any change in law which affects our ability to sell electricity, we call that a trigger event. Any trigger event allows us to then force the energy customer to buy the asset from us. Obviously, if we aren't able to finance anymore because some obscure regulation comes in, then the energy consumer needs to buy the asset from us, and that's how we deal with changes in law. And Neil, I don't know. I know there's a question addressed from Mark.
That's the next question. So this is finished with Naveen. Naveen, are you okay with that, or you have any other comment?
No, thanks, Anil. I think I get that. What we're saying is that the rate is underpinned by the contracted rate in any event. So you're unlikely to lose any money there. I think I was thinking more along the lines of an obsolescence risk, purely because of the long span, 10, 12 years. So if there was a situation where it became obsolete, how would it affect you? I understand it's underpinned by the rate in the contract, but looking beyond that, the asset test, how are we going to make our customer happy is what I'm asking.
I think, Naveen, the main thing here is that the tax benefit really makes a difference, because you are de-risking your capital early on. That risk is there. I wouldn't lie about that. I mean, there is regulatory risk. There is risk that technology could change drastically. I think it comes down to then the relationship between the house and the client, and the quality of the client, and whether they're prepared to honor that. Remember, there's a contractual agreement also. So if a person wants to get out of it, there's a legal consequence. So I think Naveen, we can do it one-on-one. Let me just, is that okay for you?
No, it's fine. It's fine. I'm happy with that answer. I think it's a balanced risk at the end. I don't think it's something that is so obtuse that it's going to happen in the short term. So I'm comfortable. But thanks for that response. Thank you.
At least it's contracted. It's not a private equity risk or something.
Absolutely.
Okay, next question is from Mark Rennie. Sorry, I just missed you earlier. So the question was to Jonty. Have you had any reported issues from your clients when submitting recons or statements to Sars? That's question one. And the second question, when do you, after investing, expect to get an income? What yield and timeline in terms of income? So I'm just going to let Jonty answer directly. I think that answer is pretty simple.
So we had over 400 investors in our last fundraise in our last year. I'm not sure which percentage of that is provisional taxpayers, but let's assume 100 of the 25% are. Well, then 25% claim their Section 12B benefit at the end of February, and we haven't heard a single investor have raise an issue or an audit from SARS. So it seems that it's going really well. For our PAYE payers, which I'm one of them, we need to submit by the middle of July. And we've worked very closely with an accounting firm that has done Section 12B deductions in the past. And we've prepared a statement, which is similar to a certificate you would have had in 12J, which we think will pass SARS's requirements, as well as a guide on how to log onto e-filing, how to submit your 12B deduction, as well as other supporting documentation if there is an audit. So we're very comfortable that we've positioned ourselves that our investors will have a smooth road. Obviously, it'll be a grave reputational risk if our investors don't get their benefit. So we really, as a fund manager, incentivized to make sure that it's a smooth process. I don't foresee any issues. I'm an investor. I'll be investing in this fund as well, and I'm very comfortable around the risk. The other question is around timelines and yield. So for this fund, we anticipate the average yield is around 20% per year, and that's adding up all the cash flows, dividing it by 10, and that's ignoring the tax benefit. Dividing it by 10, we get on average around 20%. And then when do we look to pay our first yield? Probably in Q1, Q2 next year. Obviously, we need to invest into these assets. They need to be built. They need to then produce electricity, and they need to bill. So there may be a timing mismatch, but Q1, Q2 next year is kind of where we foresee making our payments.
You want to add anything, Randy, on your side? Are you good, Randy?
No, I think that.
Jonty, are you able to hear me?
Yeah, maybe Mark, just to finish off that part. So the return starts immediately once it's deployed, right? But you can start getting your first return, let's say August 25 and February 26, and maybe some return for Feb 25, especially if the money was deployed in the next 2 months. That issue with the tax side, just to reiterate, it's a tax statement, and the statement will say, this is the capital that Mark put in. This is the debt that was taken up by the house. The total value was deployed was X. In that example, let's say it was that 1.66 million in the Gaia example. And then based on that, if they did new projects, 12BA will be applicable. It'll be 125%. That's a statement. And we have received our first statement, and most statements are for the last year are going to be received by end of June. Yeah, and then the income also will come on a 6-monthly basis. So Mark, does that answer your question, or you still have a further question there?
No, that answers my question, if you're able to hear me. I made an investment towards the end of last year of, I think, 1,720,000 into Geltec. And I was just wondering whether those funds have been deployed, and when can I assume out an income?
Mark, yeah, yours was in the second tranche, right? Because I remember there was a gain, if I recall, right? Is that right? It was, I think 81% was deployed if you were in the November tranche, if I recall.
I think
yes,
that's right, yes.
Yeah.
Yes.
So basically, it will be 81% of the capital that whatever capital you put in, which was effectively 81%, plus the debt, which, so the first year deduction will just be on capital, because that year in Geltec, it was based on capital in year 1, and then the debt part will come in year 2. So this is the statement that will arrive for Feb 24 at the end of June, Mark. So the first part will be 1.7 million times, I think it's 121%, Jonty, in year 1, because they had a bit of existing project, but mainly new. And then that will be the one that your accountant will submit to the receiver. But connect with me one-on-one. I'll manage that with you, Mark.
I think just to add that all the funds are fully deployed. And, that speaks to what I was saying earlier, is investors who invest in the first tranche, the probabilities of being fully deployed is very high. If you invest in our September fund, that risk it's higher that you won't be fully deployed. So in Mark's case, 81%. Earlier investors received 100% deployment.
Yeah. Okay, Mark, is that okay in terms of the answer?
All right, thanks.
Okay.
Yeah.
No, lovely. We'll connect one-on-one.
Yeah, that's perfect. It works well for me. Thank you.
Okay, lovely. Thanks, Mark.
Thank you.
Willie van der Merwe says, is it still a good investment if you're 2 years from retirement? Definitely. as I mentioned, it's you know, you're gonna get you're a high marginal taxpayer, as you mentioned. So you're gonna get like 80 to 90% of your money back. You're not limited to 350,000 in a RA. Like this is unlimited. You can clear quite a bit of your tax if you like. And then secondly, you're gonna get a yield on the full amount that you invest, although the net investment could be 15% or 10% of the total value that you invested net of the tax saving. So yeah, I mean, you get a 13 to 20-year yield based on a power purchase agreement. It's much more uncorrelated to the market, and the risk is moderate. Does anybody else want to add anything there?
Neil, if I could just add one thing.
Go for it, Jonty.
Go ahead.
Thanks, Renee. I actually think this is a better investment for someone who's retiring in 2 years' time. And the reason being is all the distributions from this investment are taxable. And if you aren't earning a salary, then your tax bracket will be much lower. So this year, next year, you'll be at 45%. In the following years, in year 3 or 4 and 5, you may be in a much lower tax bracket and paying less income tax on the money received. So I think it's an even better opportunity if you're retiring soon.
But Renee, I mean, Dr. Panamera, you'll have to retire, right? You can't be still working in high marginal tax. Does that answer your question, Dr. Mark?
Yeah. Maybe just to add as well that you know, what is important is if you have other sources of income, such as, you know, a 12B investment, solar investment, it means that, you know, if you're utilizing a living annuity, you could draw less. You could save a bit of that money for the next year, and you could preserve your life savings longer.
Cool. Thanks, Renee. Billy, you want to this comment? Are you happy with that, or you want to ask further questions?
Definitely. I think I see the benefits of that. I think that last comment around the withdrawal from the living annuity as well is actually critically important. I think I hadn't thought of that. But I think that really you can actually stagger that and draw less from that, and actually then make sure that you actually maximize on everything going forward. So definitely, I'm comfortable with that. I think Section 12J worked well. So definitely, I think that this is a real possibility.
No, great. We'll engage one-on-one. And remember, in my slide, I said, you know, you could use alternative assets for this. This is a fantastic example of that. And I had there, you can either have things that support your income. There's a fantastic product that can support your income in retirement at a lower tax rate, especially if you're supplementing your annuity. We're really out of time now. It's also been quite an engaging Q&A. Apologies for being late. I'm just going to finish the last question. And there was a question by, please tell us about carbon credits. Jonty, can you do 30 seconds just quickly? And then I have one question for Ritesh. And I hope we've answered all the questions now. Yeah.
So you know, businesses that pollute, like say Sasol, as an example, they need to offset their pollution by purchasing carbon credits. And if you're an energy producer who produces clean energy, well, you produce carbon credits. So we can take these carbon credits and we can sell it to the highest bidder. And there are exchanges in South Africa that are developing the exchanges offshore, where you can then place your carbon credits and sell them into the market. And that's a really nice revenue stream for owners of renewable energy. And we're looking to sell those carbon credits for our investors, and we're looking to generate an additional yield of 0.7 to 1% per year, in addition to what we're forecasting. So that's
okay.
Carbon credits.
Solar arrays, is that okay on the answer? Okay. The last question, I don't know, I'm not sure he's not responding. Solar, you want to just respond if you're happy with that?
Yeah, I'm happy with that.
Okay, super. There's one final question by Ritesh, part of a family office. So a lot of emphasis is being placed on the contract term. This is for Jonty and Jaltek. It's the last question there, Jonty, which is a long-term contract. What happens if the contract is breached? Is there any security for breach of contract? If a company liquidates, what happens to the contract? I think, Ritesh, we have answered a bit of this, but Jonty, if you just want to give a quick comment again on that part.
Sure. So first and foremost, we're really looking at credit-worthy businesses. Okay, so if there is a default, and it happens with the best businesses, we'll put the business in breach, and failing which we have a number of options. If the business is healthy and they're not paying because they're reluctant to pay, then we have that's a trigger event, and we're then allowed to force sale the asset to the business at an agreed price. So upfront in our contract, we have a price. If there's a default at year 1 all the way to year 10, 12, then they have to buy the asset. We can then start litigation and force them to buy the asset. If they're insolvent, it's our asset. It doesn't fall within their legal proceedings. We'll then go and collect the asset and hopefully deploy it somewhere else in someone else's business, but we'll then have a legal claim. That's obviously something we want to avoid. We obviously got exposure. You'll have exposure to 15 or 25 solar assets, so shouldn't materially impact your returns. But that's really our options: is taking the assets away and then you're really following legal proceedings, which we obviously want to avoid. And we avoid this by doing business with credit-worthy businesses. But ultimately, it's going to happen somewhere down the line.
Ritesh, does it answer your question, or you want to add anything?
Yeah, hi, Anil. Yeah, no, that's fine. That answers my question. Thank you so much.
Okay,
I just want to make you aware of this fraudulent email which is making rounds. It's
so who is that? Billy, I think you're on. You actually, can you mute, please? Thank you.
I need to do that.
Sorry.
Oh, yeah.
Yeah, you actually on mute. So I just have a couple final comments, which was some of the interesting things that were raised at the live event. I'm going to do it in literally 1 minute, maybe 1 or 2 minutes. Yeah. So one was, what is liquidity? I think Rainier, you shared that you'll have a REIT, which will allow you to have some liquidity events every 5 years, which is really a nice option. On Jonty, as you mentioned, at the year 10, they're probably going to sell the paper, which is quite possible. It's similar to property asset class, right? With a proper power purchase agreement. And if you've got a proper refurbishment of the equipment, you've got a better chance of selling at a good price. So that was one thing. And there is some liquidity, which is quite nice. Some of the houses don't have liquidity in the offering. One of the other questions was, which we had in the session on the live event was, just take a company example, just to quickly say, you won't get 90% benefit or 85 to 90%. You'll get a 56% benefit because the tax rate is 27%. And if you take the debt and you multiply it by 125, it'll work out to, on R1 million, you'll get 560,000 back as a tax reduction or saving. And then the main part is the return. You'll get tax at a lower rate, which is 27%. So over the whole term, it works out pretty decent, slightly lower than the individual, but still very good. And if you want to maximize the tax, you can obviously increase your salary, but just be aware it's nicer to keep your value in the structure, especially if you've got a trust owning the company. Just to answer the last thing on the R1 million example, we had a lot of this covered in the live. If you had a R1 million investment, just to summarize Gaia and Jaltec, they obviously got different time frames, so the IRRs are similar. So in Gaia's one, you're going to get 90% plus of your investment back in the individual, and then you're going to get at least 2.8 times from the investment yield, especially when you got like most of your money back, which is really it's remarkable, as we shared in our invite. In Jonty's example, in Jaltec, you're going to put your money in, you're going to get 85% in year 1. In Gaia's, you're going to get year 1, year 2. And they found a way to claim everything in year 1. And then you're going to get a yield of another 2.1 times from the investment case, which is really something else, especially when you only put 15% of your original investment net of the tax saving. I think from a time point of view, I can't really go further than that. I want to thank all the attendees. So a lot of people have dropped off because of time. But for all the people that stayed, we really appreciate you all making the time. And hopefully it's been valuable and fruitful for you guys. And welcome to engage with us one-on-one Jonty and Renier and Matthew, thank you so much for joining us. If you just want to make any final comments, and really appreciate your participation in our event today. Jonty and Renier, you want to just any final comments from you?
Yeah, maybe just to say we appreciate it. It's always nice to work with you and Neil, Matt, and the team, and you put us through our paces with the DD, and but you know it produces quality, and it's always fun to work with you. Thank you very much.
Thanks, Renier. That won't stop, eh? Jonty.
Yeah, I think just thanks everyone for your time. Matt and Neil, great event, huge attendance. It's always a pleasure working with you. And then for the investors, deployment is a real issue later in the year, as I've said many times. So if you are looking to invest, you should really consider one of these options as soon as possible.
Yeah, no, thanks, Jonty. It's always a privilege to have you on. And just finally from our side, yeah, thank you for attending. If you want to engage one-on-one, I suggest you guys do it sooner rather than later, because then you have a better chance of the deployment. And these options are looking really good, even compared to the previous year. So thanks, everybody. Have a good evening and appreciate your coming tonight. Cheers. Thanks, Matthew.
Cheers.
Thanks, guys. All the best.
Do you want to say anything, Matthew, to close?
I'll just say what Jonty always says, right? You're either going to pay tax or you're going to do the investment. You decide. Okay. Cool, guys. Have a good evening. Cheers. Bye-bye.
Thanks so much. It was a very good engagement on the Q&A. Cheers. Bye-bye.
Cheers, everyone. Bye.